Hello, everybody, and welcome to the Real Estate Pro Podcast Show, Episode 2. I am your host, Jose Nunez, along with my partner and beautiful wife, Crystal Nunez.
Hello.
So, how's everybody doing today? I hope you are doing good on this Wednesday afternoon. We are going to be talking in regards to a good subject today. We're talking about credit.
So I think credit is a pretty big issue because since the last podcast, everyone's been asking what they should and should not do when buying a home. I think that's kind of a vague topic that people always want to know more about.
What they should and should not do in regards to credit, and I guess some
So
specifics on it or something like that.
I think the first thing that people want to know is like what the first thing that they need to do in regards to their credit. Like what's the biggest thing they need? Where do they need to
Well,
start?
first of all, people need to run their credit. They need to find a mortgage professional and get their credit ran. And I say that because it seems that there's a big fear of running your credit. And people will say, oh, I want to buy a house, but I'm afraid to run my credit. I ask, well, why are you afraid to run your credit? And they say, well, I don't know if it's good enough. I don't know if I have, I don't want my credit score to drop. Um, I don't know if I have a lot of debt. I don't know what debt I have. A bunch of unknowns. And I think people need to get over that fear and just run the credit, because without running the credit, you don't know where it is that you need to go.
I think that's a key point is that you need to start somewhere. And there are common hesitations of not wanting a mortgage professional to even have their credit ran because they're in fear that it'll lower their score. They don't want people to see what's on there. They don't want their spouse to see what's on there. I think we've been in those situations where we kind of had to break the ice. And also, they kind of are scared to find out what's even on their own credit report.
Hmm.
So, as far as running the credit for a buyer, a potential buyer, should they run it if they are married? Should they run their credit with their spouse or should it be ran separately?
Well, if you're planning to buy with your spouse, then you should run it together. If for some reason one spouse doesn't qualify for whatever reason, we could actually have the credit company that we use separate the credit reports, and we could use the credit report that is going to be used to purchase the house. But ultimately, yes, if you're going to use two people to buy, then you need to run both credits together.
Because I know I've heard that a lot. Like, we don't want our credit to be ran together. We keep everything separate. We file our taxes separately. Does that even like matter?
Well, I think there's many systems that banks use nowadays, or even just all these different tracking systems, where people think they're hiding something, but it's not really being hidden. A perfect example would be somebody's trying to hide a foreclosure. Well, when you're getting a home loan, the banks run your name through a system where they cross reference everything, and they'll know if you had a foreclosure, they'll know if you had a bankruptcy, they'll know if you have a judgment, whatever the case is. It's most important to bring it up. If you know you have a bankruptcy, a foreclosure, short sale, any of that stuff, it's better that you bring it up in the beginning, because it's gonna come up later. And
Hmm.
if it comes up later, it could ultimately cost you buying your home.
So, bottom line, there's really no repercussions to running your credit together or separate because it can always be separated.
It can always be
Okay.
separated, exactly.
So, I think another question that people have is what are we looking for in terms of qualifying someone to buy a home in regards to their credit? Like, what is it that we're looking at on their credit report? What do we want to see?
First and foremost, we're looking at for the credit score.
Hmm.
That's the beginning. The credit score. What is a credit score? And we go based on the middle of three. We normally when you're gonna get a home loan, we do run what's called a tri-merge credit report. So we get a credit score from Equifax, a credit score from TransUnion, and a credit score from Experian.
Hmm.
From there, what we do is we get the middle of the three scores. Okay. Now normally you need to be at about a 620 to qualify for a home loan. There's some programs that allow you to go as low as 580 of a credit score, but there's just some different things that you have to go through in order to get that qualification done. But it is possible. So again, the first thing we do is we look at the credit score. From there, we look at trade lines. What do you have on your credit report? Do you have credit cards? Do you have a car loan? Do you have an installment loan? Do you have collections, medical collections, student loans? We look at all that stuff. We look at what your payments are, what your from what your payments are. We calculate what's called a debt to income ratio, and then they used to pull judgments used to come up on a credit report in the past, but there was a law that passed that they no longer come out on your credit report. But again, it is very important for you to disclose that because you could be ready to close on your home and then a judgment that you never brought up pops up because title has to do a search. And if that judgment pops up at the end, it has to be taken care of. If not, you're not going to get your home.
Okay, so first we're looking at credit score. We're looking for a minimum middle score of 620, just so we can like recap.
Yes.
That's what we want to see as the mid score. Second of all, we're looking at trade lines. Do you have sufficient trade lines? Do you have credit revolving in your own name?
Exactly.
What's your open credit to your balances? I think that's a big one that people don't factor in. All of that matters and it does impact your credit score, but they also want to see the actual trade lines.
Yes.
Another thing is, although we don't see judgments, those are things any mortgage professional wants to know up front because you can't hide it. Even though it's not in your credit score or your credit report, it's going to come up at the end because there's always like an SI that's around where it kind of like pulls your information and it'll come up later.
Exactly.
So it can hurt, it might not hurt you up front, but it'll hurt you later and it could ultimately prevent you from getting your home.
Yes. And what I try to tell people is, look, don't try to hide something because it's going to come out. So
And we can kind of try to work it out.
yeah, the sooner you disclose it, the faster, the better you could take care of it. So it won't affect you.
So I've heard people buying as low, with as low of a score as a 580.
Yes.
What does that entail and what program is that?
So that would be an FHA loan. And what happens is when you're below a 620, again, the loan is doable from a 580 score to a 620 score. But what happens then, it's manually underwritten. So normally what happens is you get a loan, we put it through an automated underwriting system where it gives you an approval, and you get those conditions fulfilled to the underwriter. What happens is when you're below a 620, there's a person who actually looks at everything and underwrites everything. So it's a little more, the process is a little longer. It's looked at a little closer. And then the debt to income ratios are also a little lower because the credit score is lower. So ideally, you do want to get to a, it's stricter, correct.
Okay, so for a 580, it is possible, but the guidelines are stricter.
Yes.
And your ratios have to be tighter.
They will be lower, so that means you would qualify for less home.
And does it impact your interest rate and your down payment?
Down payment would be the same, but it does impact your interest rate. The higher the credit score you have, the better interest rate you'd be offered.
Okay, perfect. Okay, so I also get this question a lot. Don't run my credit. I have my Credit Karma.
Yes, I love that. That's a very good question. So Credit Karma, it's a very good option for you to monitor your credit, to see what's on there, to see what your balances are, to see if there's any inaccuracies in your credit. Okay? But the score that they give you is not the score that's going to be generated by the Tri-Merge credit report that we pull. Mm-hmm. Because what happens is when you're applying for a home loan, the credit bureaus use some system that generates the credit score. So it grabs all your credit data and it generates a score. When you're buying a home loan, the algorithm pulls all your credit report to pull a score. If you're buying a car, your credit score is going to be different with the same bureau because it's pulling the information differently for a car. Mm-hmm. If you're getting a credit card, the same thing applies. The credit score is going to be different, even though it's the same bureau. And then Credit Karma, same thing. It runs it a little different.
So in all that, what you're saying is that it's a different model score that they're using.
Exactly.
Okay, so Credit Karma, what they're using is your Vantage score. It always comes out either a little higher or a little lower, but ultimately it's not going to be the same score that they're using to qualify you for a home loan.
Exactly. And I've seen the score be different by over 100 points, higher or lower. So if you see your Credit Karma score and you think it's low and you say, oh, I don't even want to run my credit, I encourage you to do so because it might be higher than what Credit Karma is saying.
Okay, so you still need your mortgage professional to run your credit to see exactly where you stand in order to qualify for the home loan that you want to get to purchase your home.
Correct.
So what if our score or the buyer score is not high enough? What would you advise them to do?
So that's a good thing you bring up right now because I had somebody who contacted me today and they said, hey, look, Jose, I'm trying to buy a house next year. I want to take care of my credit. And I said, okay, great. Well, what is it that what are you doing with your credit exactly? And they said, well, I'm paying off some collections and then I'm going to be ready. And I said, well, don't do that just yet. And I say that don't do that just yet because when a mortgage professional runs your credit, we have access to a credit simulator where it'll tell you certain steps to take to increase your credit score by so many points. Now, we can't guarantee that your score will increase by the amount of points that they're saying, but in my experience, what I've seen is that it always goes above what they're saying. So,
Okay,
and
so
sometimes that includes not paying off certain collection accounts.
the credit simulator ultimately can save a person trying to qualify time and money because they're not just guessing, okay, I need to pay all my collections. Because some things you really don't have to pay off.
Exactly. Some things you don't have to pay off. Some things are very old where you don't, it doesn't help you by paying them. So, about 10 years ago, we used to guess. We used to say, okay, if you pay down your credit cards to 50% and you pay off your collections, your credit score will go up. Well, that was a guess at all times, and we never knew exactly what was going to happen.
Mm-hmm.
Now with the simulator, we have we get to see
The insight.
the insight. We foresee what's going to happen, and sometimes it's the craziest things. Like I've seen it suggest to open a credit card with a $300 limit and use $10. I've seen it suggest to pay a credit card down by $20. I've seen it suggest to pay another credit card off by a couple hundred. So it gives some crazy suggestions, but in my experience it works.
Mm-hmm.
So
And in my experience, it does work as well. I know that it's been very successful for us with our clients and our own purchases as well. When we've had to go up a few points and we don't want to overspend or kind of guess and waste time. So, along those lines, is it beneficial to always use a credit repair company when trying to fix your score or get credit ready?
I personally wouldn't say it's very beneficial to use a credit repair company all the time. What a credit repair company normally does is they'll dispute information for inaccuracies, and it may or may not come off. So it's kind of like a flip of a coin. And ultimately, if they do remove things, sometimes they end up coming back uh, onto your credit report. So again, I would recommend get your credit ran by a mortgage professional, let them run a credit simulator, and you could go from there. There are cases where you do need a credit repair company where you need to have things disputed and removed, but it's going to be every case is particular, and you want to go and check your particular situation to see if that helps you or not.
So my
Because one, I'm sorry, didn't mean to cut you off, but that's an expense that you may not need to pay.
I agree. And so my experience is that credit repair companies are great for someone who has, a very lengthy credit report and they're kind of lost in the middle of it. The credit simulator isn't giving us all the points and we kind of need to be a little bit more creative. But you are right when you say that it's really hard to project the time frame, especially when some deals, they kind of like take all these different turns and a buyer ends up, they open escrow and 3 months they're still in escrow because of all these unforeseen things. You just don't know when things are going to fall off and if their credit's going to be ready or if things are going to pop back up that
Yes.
were removed. So that's good information because credit repair can be lengthy.
It can be lengthy. And it's funny because if you ask a credit repair person what their pet peeve is, and it's getting a client who's currently in escrow and needs to have items removed now,
Well, so
yesterday.
that kind of brings us back to how we met because I used to have a credit repair company.
Yes.
But my approach is I did help people fix their own credit, and when they couldn't, I would kind of come in and help them. But I know that my biggest pet peeve is when people just wanted to have perfect credit because you can't go from having bad credit and then just want a 720. I mean, is it possible? It's possible, but I loved having a goal and a clear, objective. So what are some of the things that like pointers you can give buyers? Like what should they not do while they're in escrow? Because I know it happens to us with our own clients. What are things you see happen that kind of,
The biggest thing that people need to not do, potential clients need to not do, is buy anything while they're currently in escrow or open new credit.
so no buying all the furniture for the home they don't have keys to yet?
It's funny because I've actually experienced where somebody was ready to close escrow. They went out and they bought brand new appliances because it was on sale and they wanted to take advantage of the 0% interest. And they happened to rerun their credit right before we closed. And guess what?
It dropped.
No,
Or
no,
they were at a ratio.
their credit didn't drop, but they no longer qualified for their house.
Oh man.
So now they had all their appliances, but no house to put them in.
Yeah.
So don't do that. I've also seen situations where somebody co-signed for somebody for a car, for a credit card, and their response is, "Well, it's not mine. I co-signed." Well, if you co-signed, it's yours.
Or it's
So
your responsibility and it does impact your score.
it does.
So, okay, so of course, don't open new accounts, no large purchases while you're in escrow until you're like, well, when would you say is a safe point?
Ideally, no purchases with your credit cards until you close escrow. And when is it safe? Once your transaction records.
Okay,
So
so
once
once the transaction records, it's yours, then you can go make the
then
purchases. You
go
can
run your
do it.
credit as much as you want. If you don't want to refinance.
Okay. So, let me see. Going back, I think you had made a point right now that I kind of wanted to go back to. Um, trying to think. When you co-sign,
Yes.
okay, what is the legal responsibility that you have? Because we've seen that as well.
Hmm.
And I've seen it work both ways, where someone co-signs for a car, right? And they're able to prove to the bank that they're not financially responsible and they are still able to qualify. So in what cases is it okay to say, okay, I co-signed?
So when you co-sign for somebody, essentially you're saying that you're vouching for that person. So if they for some reason miss a payment, you're responsible for making the payment. And if you don't make the payment, then guess what? Both of you are gonna get a negative hit on your credit report. Okay? What happens is when you're co-signing for somebody, let's say for a car, a lot of the times they ask you to co-sign, but you're put on the application as a first borrower and they're put on the application as a second borrower. Well, when you do that, a bank looks at it as it's your car, not their car, because you didn't co-sign. You're the first borrower.
Okay.
So if you are gonna co-sign for somebody, what you do want to make sure and be careful because the car company, the places at the car dealerships, they're gonna tell you it doesn't matter and all this other crap. But the truth is it does. You got to make sure that that person's gonna be number one on the application. You're gonna be number two, and in order for the bank to not count that payment in your debt to income ratio, you're gonna need 12 months of payment history from that person making the payment from their account. Okay, and I say that that's important that we clarify that because what happens is sometimes is they'll the person who bought the car will give the cosigner the cash and then the cosigner makes the payment because they want to make sure that the payment's not late.
Right.
But when you're paying cash, that's not traceable.
Okay, so if you are going to co-sign for someone for a car, for example, you need to make sure that you're the second borrower
Yes.
and that they're making the payments out of their own bank account so that you can prove to the bank when it comes time to buy your house that you're not making the payments and it's not your financial obligation, so that payment doesn't work against you.
Correct.
Okay.
And you cannot be on that bank account as well because if it's a joint account or whatever, it's like your account as well, like you're making the payment.
Now, when you're trying to improve your credit, I know a lot of people will say, oh, I'm going to add so and so to my account so that they can become an authorized user to bump up their FICO. Do you think that that always works?
It doesn't, and actually, I've seen it actually hurt somebody. I've seen the simulator has. I've seen the simulator recommend for somebody who's been an authorized user on somebody's account to be removed from that account, and by removing them from that account, it's actually bumped up their score. So there's been situations where it's helped, and there's been situations where it hasn't helped. So again, that's going to be a case by case basis to people's particular scenario.
I think from my experience when I used to help people with their credit, it has been beneficial to have them as an authorized user. But where what you're saying, when it is kind of more detrimental is when that borrower, when their account is not in good standing or they have a high debt to credit ratio, so it ends up like hindering their credit score and bringing it down.
Yeah.
So an easy fix in that case would be to remove the credit from the report, and then it kind of bumps up the score quick.
And keep in mind that banks also they change with the times and they realize that many people began getting added as authorized users. And I think credit companies also noticed that and they kind of changed the significance of what impact that'll make to help people because they kind of caught on to what was happening. So
Okay. So sometimes it doesn't even, I mean, just from my own experience, I've noticed that authorized users don't even come up on the credit reports
sometimes it doesn't.
because they're not using the actual social. So you really have to be clear when you're looking to add someone to your credit history or to a credit card that they are using the social so that it's reported and that it is reporting to the three bureaus, because you might be spending the time thinking that you're going to accomplish something and then you don't.
Exactly. Yeah.
So what about any other tips that you can give buyers as far as credit?
I mean, really, I would just say make your payments on time.
Yes, I've seen that as well, where you're in the middle of escrow and they're late. What have you seen there?
I I don't know if why it happens, or sometimes it just seems that as you're in the transaction, you make a late payment or something.
If it's a late payment, I know it better have been your only late payment so that you can have them remove it because they do that sometimes, right?
I have seen that, and it depends on the card, and you really gotta beg and plead,
And your history. So always
yeah,
pay on time so that when you need the favor,
they could
you
do
have
it.
the credit to ask.
But yeah, I would say make your payments on time, keep your balances low if possible, and try not to have too many credit cards open with lots of credit used. Don't max out your cards as well.
I think another thing that people are kind of unclear about, well, some people, is does an insufficient funds charge, do those affect your credit or the buying process?
Well, the insufficient fund that would be on your bank account,
Hmm.
and it can affect if you have too many. I had a client one time who, and it's funny because now Chase bank statements actually they'll say you have so many charges for
I think
this
it's
year.
on the first page,
No,
right?
it's on the last page, but it says
Oh,
it. And I had a client who had about $4,000 in insufficient funds.
for the year.
Now, the funny thing is that his response was, "Well, I I just wanted to go through and I just cover it later." But an underwriter looks at that and they say, "Wait a minute, this person's not managing their finances well." So you want to try to avoid that if possible.
Yeah. So when you are in the home buying process, they are going to ask for bank statements, and that it, although it doesn't directly impact your credit score and it's not on your credit report, but it does bring your credit worthiness into question for a large purchase like a home.
Like a home,
So if
exactly.
they are like analyzing your bank statements, then you definitely want to keep those in check and not have insufficient funds.
You don't, yes. And speaking of bank statements, also, you don't want to have very large cash deposits because you need to source whatever deposits come into your bank account. And if you have a large cash deposit or multiple cash deposits, the bank is not going to allow you to use those as a down payment or as closing costs for your home.
I think that's a good point because even though it's not directly related to your credit, they're going to question where the money came from and it is going to impact how they make their decision on your credit worthiness. What do you think is calculated into that whole theory behind large deposits?
Well, there the reason they do it is because they want to source the money to see where it's coming from, and they're doing that because there was a lot of money laundering happening a few years back, and they I don't know exactly why or what happened or whatever, but I know for bank loans they started saying, well, we can't have large deposits. We need to see where the money is coming from. So they start saying, what is this deposit? So you could have a large deposit, let's say of 5 checks that equal $5,000, and you could print out the copy of the checks that you deposited, and that's a source deposit.
Hmm.
But if you just have cash or whatever, that's where they start questioning where is this coming from, and we could use it or not use it.
So these are all tips for home buyers that are looking to purchase a home. So let's just recap.
Hmm.
The first thing that people need to do, of course, is run their credit.
Hmm.
Let your mortgage professional, run your credit and kind of see where you stand. You kind of have to get over your common hesitations. It is okay to buy with us or to run your credit with a spouse,
Yes.
or you can do it separate. How you file your taxes doesn't matter. You can run your credit together or separate. We need to pay attention to your FICO score,
Yes.
or the score that's run from your credit report that your mortgage professional pulls. Credit Karma is great for monitoring your credit,
Yes.
but you can't use that to qualify yourself for a home loan.
Hmm.
And the Vantage score isn't what we're going to use to qualify
No.
you as whether you're credit worthy or not. And if your score is not high enough, you can ask your mortgage professional to run a credit simulator to see what you need to do to get your points upper
Higher.
or higher.
Hmm.
And you don't always need to ask a credit professional to fix your credit.
Not all the time.
No big purchases,
No big purchases.
no insufficient funds.
Yes.
Okay, so that kind of sums it up. Do you think that there's anything else you want?
At this point, no. I think we pretty much covered credit, what you need to do, where you want to be. And if you have any questions in regards to that, you could go ahead and reach out to us. Ask any questions in the comment. You could reach out to us on Facebook at Jose and Crystal, Jose and Crystal with a K, Krystal, Home Selling Team. You could reach us at on Instagram at the same at Jose and Crystal Home Selling Team. You could reach out to myself on my cell phone. You could text me or call me at 626 255 4400. And again, you could also just comment below and we could answer the questions in the following show.
And if you have any credit issues that you're working on or you need help strategizing to buy a home, then we're here to help you as well.
Yeah, we definitely are here. This show is for anybody who's interested in buying a house, who's interested in refinancing. If you're currently in the process and things are not going too well, they're kind of shaking, they're telling you you qualified and now you didn't qualify, reach out to us and we could help you. You could have a second set of eyes look at it and see if we could help you with that.
Okay, great.
All right. So other than that, I want to thank everybody for joining us today. Stay tuned next week for the Real Estate Pro podcast with Jose and Crystal. Signing
Home
off.
selling time. Okay, signing off.